Good day. What we are going to tackle today is about installment sales accounting. Traditionally, under revenue recognition principle, revenue are only recognized when the earning process is complete or the services are completely rendered or an exchange has taken place. So there's already an exchange in goods and consideration, so it's like payment. These conditions were similarly indicated under Pass number 18 to the Philippine Accounting Standards number 18, wherein revenue is recognized only when it is probable and measurable. Probable that future economic benefits will flow to the enterprise, and measurable can be measured reliably. So these are the two generally circumstances of when revenue can be recorded. So generally, realization is deemed to occur on the date of sale, as we have in our accrual basis. So when revenue is earned regardless of when the payment is received. Thus, the date of sale of transaction is the moment when the revenue is recognized in the financial statement. However, we have an exception. So these are installment sales that we are about to tackle, construction accounting that I'll be having another video with, and franchise accounting with a separate video as well. With an installment sales accounting, under US GAAP, generally accepted accounting principle, installment method of accounting for sale is not acceptable unless, so this is just an exception, circumstance exists that such collection of sale is not reasonably assured, so there's less likely of assurance, and no reasonable basis for estimating the degree of collectibility, so there's good chances of uncollection. It requires that revenue be recognized at the time of collection. But in installment sales method, it allows revenue to be deferred, so we have an account of deferred gross profit and recognized each year in proportion to the receivables collected during the year. Receivable accounts and deferred profit accounts must be kept separately for each year because the profit rate will often vary from year to year. So we are saying that we will be having an entry of these special accounts, the installment receivable accounts and deferred profit account, which exist only when installment sales is existing in a certain entity. Now let's take directly to our sample problem. What do we have here? Okay, so sample problem, data below pertaining to installment sales of COVID store. Timely COVID store. We consider down payment at 20%, so there's an upfront payment of this service. Installment sales 545,000 in 2010, 785,000 in 2011, and 968,000 in 2012. Markup on cost is 35%, and collections after the down payment 40% in the year of sale, so 40% in 2010, 35% a year after in 2011, and 25% in the third year, which is 2012. So assuming with this given data, 2010 by 2012 are fully collected. So the 545,000 by the third year are fully collected. These are all the data. Now what is being asked? So compute the installment accounts receivable. This account only exists for those company with this special exception or circumstance of having an installment sales accounting at the end of 2012 and deferred gross profit at the end of 2012, so at the end of third year. So this installment sales, as we have discussed, only exists when there's no reasonable assurance and at an expanded period of time. So what are the industry sample of this? We can say that this COVID store or COVID enterprise or COVID company is a real estate, because most of real estates collect their sales in an expanded period of time, and collectability of it may be less likely. So it's as to management's assessment. Okay, so how are we going to solve this? Installment accounts receivable, as we know, is a debit account. It's an asset account. Okay, so how we will start this? We will account for installment accounts receivable in the first year, which is 2010. 2010, we have as well 2011 and 2012, which is the third year. So let us say in 2010 sales. By 2012, because we are asked to provide the installment accounts receivable by 2012, and with the given data, it's 0. Because as it is said, 40% in the year of sales, so in 2010, 35% in 2011, and by 2012, all the 2010 sales are fully collected. So by 2011, so what percentage has been left for collection? So it would be 25%, right? Collectibility. And then in 2012, which is here, sales, so it would be better. Okay, sales on 2011 and sales on 2012. So consider all this data that were given. Okay, so the remaining collectible in 2011 is 25%. In 2012 is how much? 60%. Just make sure to first lay out all the data based on the given sample problem. Okay, now let's consider the amounts. In 2012 installment sales, we have 785,000. Now it says that 20% has been paid upfront, which is the down payment. Let's multiply it with the net percent of the down payment, which is 100% less 20% is 80%. So the 2011 sales, installment sales times net of down payment times the remaining collectibility would be 157,000. Now let's consider the sales on 2012, which is 968,000 times net of the down payment times the collectibility amount, collectibility percentage. So that would be 464,640. Add it all up. Okay, so we got this amount, the total. And this is our answer for the installment accounts receivable in year 2012. Okay, so hope it's clear so far. Okay, so it will be better. Now let's move on to the next requirement, total deferred gross profit. So here, since in 2012 this is the total installment accounts receivable, we can easily get the gross profit, as we have learned per data given that markup on cost is 35%. And so, since this is receivable, this is comprised of the cost and the markup on cost already. Now, we can directly get it deferred gross profit on the same year, in the same year, 2012. Gross profit in same year, which is 35% of cost. So we say that this is 135% because this includes already the markup. Okay, so let's have 621,640 times the 35% divided by 1.35, or we can have this percentage, the 135. And here we got. Okay, so this is the deferred gross profit. So now we got these two. And that's it.